Welcome to the license class study for life insurance. For today, we are going to cover policy provisions and riders. This is part 2. We covered part 1 in a separate video, right? So policy provisions and riders. So some of the elements that you need to remember that appear most on the exam is accidental death benefit rider. It pays additional sum to the beneficiary death if death happens due to accident. So usually double or triple. It's also called a multiple indemnity rider. Indemnity is restoring to the financial condition. So life insurance is an indemnity contract. So if we say multiple indemnity, is that the death benefit is doubled if the death is happened due to accident. Of course, people pay more premium for accidental death benefit rider. So if it's due to accident, you get additional coverage. So what appears on the exam is that which of the following will give you additional coverage if this happens due to accident, or it can ask you a double or triple, right? So, but it is important to know that if the death is related to accident, you get more insurance coverage, right? Benefit payment. So accelerated death benefit rider is another important term to know. It's also called living benefit. Accidental death benefit is called multiple indemnity rider, and then accelerated benefit rider is called living benefit. So it will allow you to receive part of the death benefit while you are alive due to an illness, right? So that's also important. Most of the life insurance that we do have living benefits, so people can get a portion of the death benefit while they're alive if they have critical, chronic, and terminal illness as well, right? Assignment clause, right? An assignment clause is that you can assign the right of your insurance to another person or entity. So there are two important ones. One is called an absolute assignment. So an absolute assignment, you're giving all the rights to somebody, right? Or a collateral assignment, it can be for a short period of time. So the assignment is given to a creditor usually. So if you have a loan, to secure the loan with the life insurance, we can do collateral assignment. So you can see in the exam question, what can you use for credit insurance? A collateral assignment, right? And this type of question also, which of the following permanent change of ownership of a policy? And that's an absolute. So permanent change is an absolute assignment. So once you change that, that's it. It's an absolute assignment. You cannot get it back. So usually collateral is the most common use, right? Dependent rider, also you can use child rider is a way to add additional insured. So if the family is insured, the child can be added to that policy as a rider, as an extension, as an endorsement. So so that dependent rider is adding additional insured, right? Which of the following will add an additional insured to the policy? If you see a dependent rider, a child rider will add to the policy as well, additional insured. Policy provisions and riders. Exclusion is one of the common terms that we use. A policy will not cover for certain risk. For example, war is excluded, right? War is excluded. If a soldier is dying at war, and then the life insurance will not be paid, it pays if the death is related not to war, right? So exclusion is what we use the term, right? There's also incontestable period. It is 2 years, and then the insurer cannot challenge a validity of a policy or any representation from the insured. If it happens within 2 years, and then the insurance company can cancel the policy, can raise the premium. But if it happened after 2 years, there's nothing that the insurance company can do, right? So that's called incontestable period. So the exception to incontestability is misstatement of age. If an age is misstated, right, and then the benefit has to be corrected, right? The benefit, when the benefit payment comes in, so insurer pays amount of premium would have purchased at the correct age, or we say the insurer adjusts the policy benefits according to the corrected age. So that's very important. So to know any mistake or any intentional mistake by the insured in the application is only contestable within 2 years, and it becomes incontestable after 2 years, right? Payer benefit rider waives a future premium for a juvenile. So payer benefit, so who needs a payer, right? So a juvenile cannot work, right? So they need their parents are paying for the insurance, so payer benefit rider covers a juvenile. So that's a good correlation, right? So if the payer of the premium dies or becomes totally disabled, and now the premium is waived. So the most common question that you might see, it's very confusing for people, is that waiver of premium, right? Waiver of premium is for the person, right? For the insured. It waives the premium if the insured is disabled. But this one is waiving the premium for the juvenile. It's a payer benefit, right? So you need to connect those. Policy loans are not taxable. If you take a loan, you don't pay taxes on a loan, right? Interest that is paid to the insurance company on a policy loan is not tax deductible either. So you need to know these two. If they come in a multiple choice, you should be able to know not tax deductible and not taxable, right? Insurance companies have the right to defer policy loan or a payment of a cash value for 6 months. So these are some of the numbers that you need to remember. 6 months, the insurance company can delay, right, the payment of a cash value, right, or a loan. A non-forfeiture option are options you have for your cash value if you terminate the policy. So the options that you have for your cash value is called non-forfeiture option. You're not forfeiting the policy, so you can take the cash value out as well, right? A reduced paid up addition allows a policy owner to reduce a policy benefits amount in return to making premium payments, right? Instead of stopping making premium payments, a reduced paid up option is used, right? Extended term option, use policy cash value to buy level and extended term insurance for a specified period. No further premium payments are made, and then the coverage provided with the extended non-forfeiture option equals to the net death benefit of the lapsed policy. So it cannot be more than the original policy. So you have the extended term option as well for the cash value, right? Suicide clause states that if someone is committing suicide after having life insurance, only a return of premium. Only a return of premium if that suicide happened within 2 years. So the 2 years incontestable for the suicide applies, right? Suicide clause is 2 years. If suicide happens within the 2 years, there is no benefit payment, only a return of premium. But if suicide happened after 2 years, and then that will pay a full death benefit as well. So suicide clause and incontestable period protect the insurer against adverse selection. Right? Someone intentionally having life insurance to commit suicide, that's an adverse selection. So, and then incontestable period, somebody lying in the policy to get lower insurance. So those two are protecting the insurance company from adverse selection, right? So which of the following will protect the insurer against adverse selection? So remember the suicide clause and incontestable period, right? What happens when this happens after 10 years due to suicide? right? Death benefit will be paid. After 3 years, death benefit will be paid. If it's under 2 years, it's only a return of premium, right? It's only a return of premium. So now questions, what does the grace period allow? What does the grace period allow? Make a premium payment after the due date without loss of coverage. Allow full refund after policy delivery. Contest the term of the policy after the issue date. So the first one is the correct answer, right? It will allow you, grace period will allow you to make a payment after the due date, and then you have not lost coverage, right? So the second one is a refund. It's a free look, right? Get a full refund after policy delivery is a free look, right? It's not a grace period. So you need to differentiate those. Should be able to answer. Which of the following will protect the policy owner from an intentional lapse? It's a grace period, right? Policy is not paid, so it's protecting you. You still have the policy. So an intentional lapse, if you see that in multiple choice questions, you should answer grace period. Protects policy owner from an intentional lapse. What is the effect of accidental death benefit on a policy cash value? Accidental death benefit on a policy cash value. Policy cash value is not affected. Increases the policy cash value, decreases the policy cash value. So accidental death benefit doesn't affect the policy cash value, right? Does not affect the policy cash value. It only affects the premium, right? And you get a higher additional coverage if that does happens due to accident, right? So it does not affect cash value. It's good to know all the elements here, right? All right, the last page. After a policy has lapsed, which provision allows the insurer to continue coverage? To continue coverage. So the policy has lapsed. Now we are talking about the grace period ended. 30 days has finished. Now the policy is lapsed. So what will allow you to continue coverage? The entire contract provision, reinstatement provision, non-forfeiture provision, right? So grace period provision. So the correct answer is reinstatement provision will allow you. So you can put it back to life, right? Of course, you have to provide proof of insurability. You have to pay past due premium, but reinstatement will allow you to continue coverage, right? So, and then the grace period is only 30 days. It's protecting you from unintentional lapse. Which of the following is not a common life insurance policy rider? So automatic premium loan, waiver of premium, accidental death, extended term, right? So extended term is not a rider, right? Extended term is not a rider. It's a cash dividend option, right? It's a cash dividend option, but it's not a policy rider. So an automatic premium loan rider, you can add it to the policy, right? You can take automatic loan to pay the premium, right, from the cash value. A waiver of premium, right? If totally disabled, you can have that rider, and then premium is waived, right? Accidental death benefit is also a rider that you can add. If the death happens due to the accident, you get more cash, and extended term is the answer, right? Hopefully this was helpful. Please stay tuned. Don't forget to subscribe, share, and like.